Welcome to the Whole Life versus Index Universal Life playlist. The purpose of this series is to give you a more in-depth understanding about how whole life insurance works, how Index Universal Life works, where the difference is between the two, and ultimately, hopefully, you'll be able to make a better, more informed decision for yourself as you move forward, either making a purchase, or if you're looking to sell and become an agent, or you maybe already are an agent, you'll be able to make show up as a better agent for the clients in your life. And so here's the deal. This video, we're talking about the rising cost of insurance, because a lot of people say that Index Universal Life is a cheaper form of insurance than whole life. They say it's a more enhanced product as a whole, and that's what we're going to be covering in this series as a whole. But for this video specifically, we're going to focus myopically on the cost of insurance and control of insurance charges inside of the policies. We're going to go through two different illustrations and show you literally comparing one versus another, and you're going to have a lot of clarity. So if you haven't already, make sure you subscribe and hit the bell. That way you're notified every time a new video in this series comes out, because it's extremely important. Everybody needs to know this before you make a decision or before you sell another policy. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and this video we're talking about whole life insurance versus Index Universal Life Insurance and the cost of insurance. And so I'm excited to get into this and talk about it, because at the end of the day, this is, I think, some of the most important stuff. If you watch my channel, you know that I believe Index Universal Life is one of the most misrepresented financial products on the face of the earth. They like to steal all the good stuff from the whole life, and they, ultimately talk about all this upside, and they don't talk about the downside. And so the purpose of this series as a whole is to give you that clarity. That said, I want to let you know that I do have a bias. I used to be an Index Universal Life agent. I was the director of business development for one of the top companies in the country at the time, that is now the top company in the country for IUL sales as far as volume goes. I couldn't sleep at night. I had to get away from it. And so I shifted over because I realized everything I was preaching really was more in alignment with whole life than it was IUL. And so I just couldn't put my head on my pillow at night in full integrity without making a shift. So I had to make some big shifts. I did that about 9 years ago. And ever since then, I've been a huge whole life advocate. And I think as you go through this series, you're going to find out why, and hopefully you'll understand on a bigger level. So here's what I kind of did for this video. I want to talk about whole life versus Index Universal Life. I want to go through the difference in how insurance charges function inside of the policy. So this is the foundation that I think is important for you to understand, is that whole life has a set or fixed cost of insurance that is in place right out of the gate, whereas Index Universal Life is always increasing. It's ART, annual renewable term, and the cost of that insurance goes up every single year. I'm going to go into this. I'm going to actually show you an illustration, show you how that works. With whole life insurance, I'm going to show you how you are in control, meaning if you hit a place and you want to be done funding the policy, you can actually control the insurance charges, and you can actually pay it up. You can pay the policy off, reducing and having no more costs inside of the policy and just benefiting from the cash growth from that point forward. Whereas in IUL, you can never pay the policy off, right? You can never pay this policy off. It's always going to be having charges in it no matter what happens. You are not in control of the policy. The insurance company is, right? That is the reality of the situation. So when you look at this, I think you're going to see that it comes down. Whole life is probably going to check the boxes that you're more comfortable with. And when you understand the actual risks inside of IUL and you see the cost associated with the cost of insurance with IUL, it's going to blow your mind, especially if you've been talking to an IUL agent and you have come to believe something different than what I'm talking about, right? And so here's the deal. That is something that's said, and I want to kind of reverse a little bit and spend a little time talking about this because it's really important. Most IUL agents will tell you that whole life insurance is more expensive than Index Universal Life Insurance. And from that perspective, I'll say they're right and they're wrong. At the beginning of the policy, whole life insurance is more expensive because it's a flat, more level insurance charge kind of policy. The way that they spread the expenses of the cost of insurance over the terms of the entirety of the policy. That is true. It's more leveled. Whereas Index universal life is what they call annual renewable term. So you pay for for term insurance on an annual basis based on your age and the insurable rating that you have. So at the beginning of the policy, if you're young especially, the cost of insurance with IUL is way cheaper. But the problem is you're not buying an IUL for a short-term solution. You're buying it for long-term goals and aspirations, right? And so I always say you can't solve long-term problems with short-term thinking. And if you're thinking about the cost on a short-term basis, what you have to be doing is thinking about from a long-term perspective, what does that look like? I always want to put myself in a position where I have control. If you talk to the most successful people in the world, the number one attribute they look for in any asset is control. And while a lot of IUL agents will tell you that you control the money because you have access to the money in the policy, I'm going to tell you that that's not the kind of control that you actually need for the policy to be impactful. And let's cover that really quickly. So I'm going to show you a whole life insurance policy first because it's just simpler, and I just want to get the simple out of the way. Actually, I got to go here, there we go. So as I go here, what I want to do is I'm going to zoom in on this for you so you can see it. So what I want to do here is this is a whole life policy. Now, full transparency, this policy is somebody who's 45 years old, and I wanted to show this because I had this going on for another person, and I just thought this would be a really good example to use in this situation. 45-year-old, this $12,000 a year premium. This premium, by the way, could get paid all the way to 75 if you wanted to. It could be completely paid up, and at 75, if you paid it through then, it would be completely paid up. And if you did keep funding it, you'd obviously have a lot more cash value over here, and you'd have a lot more death benefit over here, right? That just is what it is. But because we didn't fund it, you can see I'm about to show you the control and the power that you have. In a whole life policy, you can see year 7 here. Any time after year 7, where you have $82,000, you've contributed what, $84,000, but you have $82,000 of cash value, so you're almost even in the policy, and you have $297,000 death benefit in this situation. Anytime after year 7, you can do what I showed you in year 10, where what we call reduce paid up the policy. So let's just say in this scenario, a client, you're a policyholder. Policyholder gets to year 10, they make the premium payment, and then for some reason, for whatever reason, they just say, you know what, I don't want to keep funding this. Now, I would argue that you're never going to want to stop funding if you have cash flow, because if you look at year 10, you put in 12,000, the policy grew by 16,000, right, right there, and it's pretty powerful stuff. So it's grown by $4,000 more than you contributed, and if you keep funding it, that just gets better and better and better. So this would build up a dividend that could be utilized for tax-free income in retirement if you just did it. But the bottom line is the purpose of this video is to talk about the control of the insurance charges, because you can never control an IUL. It's always going to be increasing. I'm going to show that next. But here at year 11, we reduced the death benefit. You could see here, completely reduced, and we paid it up, meaning from this point forward in this contract, it is you're never going to have to worry about it. There's no more charges, no more fees, no more expenses. Everything is paid up. This policy is like a bank account on steroids at this point in time, with no fees and no risks, like zero risks. And when we look at this, we go $5,664 is the growth divided by 134,426. And that is a 4.21% growth, right, in year 11 right there. So you see you paid up, and then you have 4.21% tax-free growth from there on out. That's net all in. And a lot of IUL agents will tell you, well, that's just kind of not good, because our policies are going to get you better than that because they're conservative at 6% or 5.5% or 5%. But the general funds are in life insurance companies are only earning about 4.5% right now. So anybody that's showing you an IUL that's getting better than what the general fund can do for itself, than the insurance company can do for itself, I'm going to tell you that's just like pie in the sky thinking. It's never going to be actualized in that way. The life insurance company is not going to get you a better return than they can get for themselves, because if they could do it for you conservatively, safely, predictably, they'd be doing it for themselves. Now, and that is what it is. Now, on the other side of this, let's go to the IUL policy. And let's talk about the insurance charges there, because once again, in this situation, I want to go back to this. This is important really quick. I just want to spend a little second talking about this. I want to really elaborate. In this situation, you see we paid $12,000 a year for 10 years. That's $120,000 in premium, okay? Over that, what are the insurance charges? A lot of IUL agents will tell you, well, whole life isn't transparent about their insurance charges. Well, guess what? I don't know what the insurance charges is, because they're right. The whole life policies don't tell you and break it down like that, because they're fixed and they're guaranteed. They don't have to show it. It's all just kind of included. It doesn't really ultimately matter what the insurance charges are, because you got more money in there than you've contributed, and that's on a guaranteed basis pretty much. Right, like this is going to happen beyond the shadow of a doubt, because dividend rates, this is assuming that they pay a dividend every year, which this company has for 120 years, and we're at the lowest dividend rate that we've been in 70 years. So the odds of this not performing like this, I pretty much staked my career on it at this point in time, and that is just what it is. When we look at this, it doesn't matter what the overall charges are. You can see the cash value keeps growing, the death benefit keeps growing, because we're using paid up additions with the dividend, and the returns, the cash value, and all this stuff, like the premiums, the insurance charges are never going to be more than the premiums, because this is paid up. We've got $120,000 in, $134,000 of cash value. So obviously the insurance charges could not have been more than what we contributed, right? That's impossible. And so here's the thing. And this, from what we see here, that 4.2%, that's like locked in as guaranteed as any other asset you're gonna find in the world at that point in time. And so I think it's important that you understand that. Now, on the flip side of this, let's move over here, and I wanna take a second and I wanna show this. This is an Allianz Life Pro Advantage policy. Now, this is a guy like Dave McKnight, who wrote the book Power Zero, loves this product, and I'm about to show you that this product is one of the worst products in the financial industry, and here's why. You could see, and I didn't go back to the beginning, but this person started with $16,421.26 right here per year for 10 years. So that's $164,212, okay, of total premium paid. Now, so did this policy perform well early? The answer is absolutely, right? So this policy, you can see right here, this policy right here, $164,212.60. You can see the first 10 years of the policy, that's what they paid. Now in an IUL, they show these zeros, very similar to what I did on the other illustration with the whole life policy. But the bottom line is it's not an apples to apples conversation, because of the fact that this is an IUL and they utilize the ART, annual renewable term. It can never be paid up. You're always, even in years that you have zero, they are assuming that you're going to use the cash value and the growth in the policy to pay for the premiums. Now, this is something that needs to be taken into consideration. When people say IULs are cheaper than whole life, well, I want you to remember this $164,000 number right here for the premium. Like, that is the cumulative premium. And then I want to go back to the page that we are looking at right here. And it was actually, I'm sorry, I forgot to show one thing. Like when you see this, the rider charges and the cost of insurance, these two things together, because of the way this policy kind of does things, these fees, you can see year one, it's cheaper, 68 plus 338 for the rider charges. That seems like a good deal. The first 10 years, you can see you've paid a total on those fees of about, let's just call it $5,000 out of the $165,000. That seems really good. Compared to a whole life, is it cheaper during that time frame? The answer is IUL is cheaper, but the problem is it's not a function of what is it going to do for you short term, because you're buying this policy for a long-term solution. The question is, if you're buying this for tax-free income in retirement, what is the performance and what are the charges of this policy going to be in retirement? And when you look at this, the cost of insurance drops off, but the way they do that, it's because of these rider fees. And you could see the cost of insurance here is getting less and less and less, or it drops off. You can see right here, it just drops off, and that is what it is. But this is where the rider fees pick up. Now, by the time you hit 72 here, this is where it gets insane, because the cost of insurance, because we're doing annual renewable term. Now, a lot of agents are going to tell you, well, it doesn't really matter. If we're going to utilize IUL, we're going to use option B until we stop funding, right? And then we're going to move to option A, which is a level death benefit. So when we hit retirement and we start pulling income, we're going to use option A to control our insurance costs, and therefore it's going to shrink the insurance. But the problem is it never shrinks completely. And what happens is when we're older, that annual renewable term, even if the net amount at risk, which is the amount of insurance that we're actually paying for in an IUL, even if that number goes down, the problem is we're getting older and the cost of insurance goes up exponentially. And that's what is being shown here in this rider. And you are about to see what I'm talking about here. So as I go through here, you could see at age 72, you've already spent $134,000 in insurance charges. And that's not, actually you've spent a total of $157,000 right there if you include the policy fees and the premium charges from earlier on in the policy life. But look at this. By the time I hit 92 years old, I paid $672,000 of rider charges. The total cost of insurance and admin fees in this policy are nearing $800,000. Now, I have paid, think about this, I paid $164K in premium, right? And I've got $781,000. So let's see here. I'm going to just do this math. Like 781 divided by 164. I paid 4.76 times the amount of insurance that I paid in premium. So when people tell me that whole life is more expensive than IUL, nothing could be further from the truth. IUL is a catastrophically expensive, and people just don't understand it. And it's not necessarily expensive when you're 30 and 40 and 50, but once you hit 65 and 70 and 80, when you're utilizing this for quote unquote tax-free income in retirement, and you're using this as an investment alternative, that people, the way that agents are selling this, and you start leveraging this, and then you realize you have other loan expense exposure, which is not this video. I'm going to get into the next video. So make sure you are subscribed and you hit the bell, that way you're notified when that video comes out, because you're going to want to see that video on top of this. But just from a cost of insurance expense, you can see here, the whole life, by the way, if this were whole life in these ages, all this would be gone. There'd be no fees, no costs, no charges. It would be fully paid up. It is this time when you need it most, when you're more likely to die, when you need it for income, when you need this to go on to the next generation, that you're going to run into challenges that these fees actually eat up and put your policy more at chance of lapsing than anything else, especially if you're using it for retirement income, which I'll touch on the next video. And so that in and of itself is extremely vital to understand. And if you live longer, I'll tell you this, I'm going to just go here and we look at this. And I zoom in here and I go and I look at this and I go, all right, we're looking at $946,000 of total cost of insurance, but if you live to the age of 90. So that's like a 5+X, multiplier compared to what you put in for premium. So you paid only $164,000 in premium. They're literally, if you live long enough, they're charging you $946,000. Guys, this is the #1 profitable product any life insurance company can sell, is an IUL. For anybody that tells you that IUL is cheaper than whole life, they're either uneducated or they're lying to you. They just don't understand it. Unfortunately, I think most IUL agents are well-intended, well-meaning people trying to serve their clients in the best of their ability. Unfortunately, there's a massive lack of education around what IUL is. And all you have to do is get the policy expense report. At every IUL illustration, they're not necessarily included in every illustration. You have to request it in a lot of companies. So make sure you request it, you get it, and you evaluate it, and you do an apples-to-apples comparison against a properly designed whole life insurance policy. And I guarantee you that by the time you're done looking at them, you will pick whole life insurance every single time. That's the reason I stopped selling IUL and started representing whole life insurance. So hopefully that makes sense. If you have any questions, comment in the comment section below. If you think somebody would be benefited from this, and an agent, an individual looking to buy, please share this out with them, like the video, and that's it. I'm going to be coming out with a whole series on this, so make sure you are subscribed. That way you get it, because I don't think you're going to want to miss this. So anyway, hope Hope you found value in this and this serves you. Have a blessed, inspirational day. We'll talk soon. See ya.